Stop me if this sounds familiar. You spent weeks, maybe even months, learning a trading strategy. You studied risk management, you watched videos, you took notes, you told yourself, I will be patient, I will wait for my setup, I will not chase trades. And for a while, it worked. You felt disciplined, focused, like you finally had it figured out. Then something strange happened. The profits didn't show up the way you expected. Or worse, you started losing. Slow at first, then faster. And now you're sitting there thinking, I did everything right, so why am I still losing money? Here's the truth most traders never hear. You can follow every rule perfectly and still fail. Not because you're weak, not because trading is a scam, but because there are hidden forces in trading, 6 invisible traps that destroy accounts even when you think you're doing everything correctly. And in the next few minutes, I'm going to break each one down. Because once you see them, you can't unsee them. And that changes everything. 1, the strategy might be broken, even if it looks good. Let's start with the most uncomfortable truth. Not all good-looking strategies actually make money. Imagine a strategy that wins 60% of the time. That sounds solid, maybe even profitable. But what if every win gives you 50 and every loss costs you $100? Now pause for a second and do the math in your head. 6 wins equals $300. 4 losses equals $400. You are down $100, even with a 60% win rate. That's called negative expectancy. It means the math itself guarantees you lose over time. And here's where most traders go wrong. They backtest on clean charts, perfect conditions, no real-world friction, no slippage, no spreads, no emotional mistakes. So they fall in love with a strategy that was never profitable in real trading conditions. And no amount of discipline can fix broken math. 2, psychological leakage. Your brain betrays you. Now let's talk about something even more dangerous, your emotions. Because trading doesn't break your strategy first, it breaks you. At first, everything is fine, but then you hit a losing streak. 3 losses, 4 losses, maybe 5. Suddenly, your confidence drops. Your hands tighten, you hesitate, and your behavior changes without you noticing. You start closing winners too early. You start holding losers too long, or you take a random trade just to make it back. That's not bad discipline. That's human psychology, because loss hurts more than gain feels good. And when real money is on the line, your brain stops thinking logically. It starts protecting you, even if that protection destroys your account. 3, markets change. Your strategy stops working. Here's a question most traders never ask. Does your strategy work in all market conditions? Because markets are not stable. They shift, they rotate, they change personality. A trend strategy works beautifully in strong directional markets, but put it in a sideways, choppy market, and it gets destroyed. Small loss, another small loss, until your account slowly bleeds out. Most traders don't adapt. They stay loyal to their strategy like it's fixed truth. But trading doesn't reward loyalty, it rewards adaptation. 4, costs and slippage, the silent killer. This is the trap nobody pays attention to until it's too late. Backtests look perfect, entries are clean, exits are clean, everything looks profitable. But real trading is different. You have spreads, commissions, slippage, delayed fills, and all of that quietly eats your edge. Imagine a strategy that makes $1 but costs you 95 cents in risk. Then add hidden costs of 10 cents per trade. Now your edge is gone, not because you're wrong, but because reality is more expensive than the chart shows. 5, you quit before the math kicks in. Now this one destroys almost everyone, even good traders, even smart traders, even disciplined traders. Because even profitable strategies don't look profitable at first. You might take 20 trades, 30 trades, and still be down, so you assume it's not working. You change strategy, you start over. But here's the truth. Even good strategies need 200, 300, sometimes 500 trades before the edge shows up. That's variance. That's randomness. And most traders quit right before things would have turned around. Not because they were wrong, but because they were impatient. 6, position sizing, the hidden account killer final trap. This one is simple, but deadly. You risk 2% per trade. Feels safe, feels normal, but after a losing streak, your account is down, your confidence is gone, and now every trade feels scary. The problem is not just losing, it's losing too much per trade. Even a good strategy can't survive poor position sizing because drawdowns are part of trading. And if your risk is too high, normal losses feel like disasters. That's how accounts die. Not from one big mistake, but from small risks that were just a little too large for your psychology. So here's the truth. You can have a good strategy, good discipline, good risk management, and still lose money if one, the math is broken, two, your emotions leak into execution, three, the market changes, four, costs eat your edge, five, you quit too early, six, or you risk too much. Trading is not just about finding the right strategy, it's about surviving long enough for your edge to actually work. Now that you know the six traps, the real question is simple. What will you do differently starting tomorrow? Have a nice day, and I'll see you in the next one.